Hi guys. Okay, so in this video, I want to discuss gaps in the market. So typically when you think of a gap in the market, you would think of, places in the market where there are no candlesticks. Where, for example, typically when you have two candles next to each other, where the previous candle closed is where the next candle will open. So for example, you see this candle, this long candle, bullish candle here, it closed here. And on the very next candle that opened, it opened where the previous candle closed. But that does not always happen. Sometimes, there's so much volatility in the market that a candle that closes on the very next candle, the market will either gap up or gap down. For example, we can see that right here. We see this candle closed here, up here, bullish, but then the very next candle, look where it opened. It opened down here. And so that was actually about like a 75-point gap in the market just on these two candles here. And if I go down to a lower time frame, you'll be able to see the gaps a lot better. You'll see them more clearly, and there'll be more space in between the candles. So whenever you see something like that, if I see a gap down in the market, I'm going to be looking to potentially buy. And whenever I see a gap up in the market, I'm looking to see if I could potentially sell. Now, it doesn't mean that whenever you see a gap down, you automatically hit buy, or that when you see a gap up, you automatically hit sell. It's something that you just want to keep in mind when you're trading, like, oh, there's a gap there. At some point, price has to fill that gap. So it can be used as a potential target later on, as a potential TP, or it could be used as a potential entry point. So like in this case here, if you were buying down here, you could have used that gap as your TP if you wanted to. So that's one way to look at gaps. There's like actual spaces in the market. And to me, that a gap is not completely filled until the body of the candle fills it. For example, this gap here, you can see that this candle closed here, but then the next candle gapped down and opened here, right? So with this candle, what happened was that price pushed up to try and fill this gap, and it didn't fill it all the way. It just wicked it. Now, a lot of people will say, oh, that gap is filled. No, it's not. It's not filled all the way. It was just wicked. So in that case, it's not completely filled until a body of a candle fills it. So we had price come all the way down here. We had a support zone down here. We bounced a few times off of this support zone, and look what happened. Price came and filled this gap with the body of candles. So now this gap is officially filled, right? So, and you could have used that as a target of where you wanted price. Where you wanted, if you were buying down here, this could have been a TP for you. Or it could have been a spot where, after it's filled, you want to start to begin to look for sales now. So there's multiple ways that you can use gaps in the market. But that is just the gaps where there's spaces and no candles. And in the next video, we're going to talk about the gaps in the market where there is an actual candle there, but it's still a gap.